Slide number 7. When we're talking about the pro forma statement and the cash flow, by definition, operating cash flow can be calculated as first one we call a top-down approach. EBIT plus depreciation minus tax, which will give you the OCF. The second method is called bottom-up. If in the capital budgeting plan there's no interest expenditure, then you using bottom line net income plus depreciation, you get the same number as the top-down OCF. These are two most commonly used the operating cash flow calculation. Now, in slides number 15, let me start that. There is a third way to calculate the operating cash flow. It's called a tax shield approach. This is particularly useful when the major incremental cash flow are the purchase of equipment and the association with the depreciation tax shield. Example is you buy two different machines with a different the depreciation scale. How do we do that calculation? That operating cash flow is equal to sales minus cost. The difference between that, then times 1 plus tax rate, plus depreciation times the corporate tax rate. In our shock attractant can project, the sales is $200,000 minus the cost $137,000 as a gross profit times 66%. What do you keep? 33 is go to government, but government pay you back by through the saving you receive from depreciation. The depreciation straight lines depreciation 30,000 per year times 34%. That amount is the tax shield. The total amount, therefore, is $51,780. Now, this is what we call tax shield approach. The third way to evaluate the operating cash flow. Okay. Now let's look at some into those nitty-gritty stuff on capital budgeting. Particularly here, first let's look at the change in net working capital. Accepting accounting principle requirement, sales will be recorded when it's made, not when the cash is collected. So what is cash? But since our capital budgeting is based on cash you receive. So the cash in is equal to sales minus the change of accounts receivables. Accounts receivable changes. On the other hand, cost of goods sold is recorded when the corresponding sales made. Not so when you paid or not to the supplier. In the cash out, is cost of goods sold minus change of accounts payable. So you can buy inventory and material to support sales before any cash collections. So net working capital is a kind of money tied up by operation. The other thing is a depreciation and the relationship between depreciation and the capital budgeting. You have to use the schedule provided by IRS for tax purpose. They usually have some kind of accelerated table to do that. Depreciation by itself is a non-cash expenditure. So only relevant is due to the tax effect. The depreciation lets you reduce the taxable income. In other words, depreciation creates a depreciation tax shield. The amount can be easily to calculate is a depreciation expenditure times the marginal tax rate. Now, company usually using straight line depreciation. This is the easiest one to do. How do you calculate straight line depreciation? Initial cost minus salvage value divided by number of years. So the straight line it basically is every year the same. Every year the same. The straight line going down to the salvage value. However, when you prepare your tax liability, you are using a modify, accelerate cost to recover system, which is kind of a tax tables. The depreciation usually go to zero. And the recover period is a whole class of life. For machine, for example, sometimes 5-year class. For building, it can be 15-year class, 20-year class. By the way, office equipment like computers, you can be accelerating within 1 year, right? Let you write off what it cost. Now, because there is a always have a half-year conversion because the acceleration table is not equal amount. So you have 3-year class, you have 4 years to write for zero. 5-year class, you have 6 years to convert to zero. And the after-tax salvage on the book, the machine have zero value, but we know on the market that machine or the equipment might have some kind of salvage value, like used car, used machine. Now we have a problem because on the book you write off to zero, but it still have salvage value. So if the salvage value is different from the book value, then there is a tax effect. The book value is the initial cost minus the accumulated depreciation year after year after year up to zero. Down to zero is not up to zero. On the other hand, after tax salvage value is the salvage value you sold on the market minus the tax rate times capital gain. The capital gain means is equal to salvage value minus book value. Now, so net salvage cash flow is equal to selling price, you're selling your used car price, minus the used car, the selling price, minus what the book value, what that equipment or that car worth on your book. Then time tax rate. Here is one example. A depreciation and the after-tax salvage value. The car you purchase is originally cost you $12,000. The car is belong to what we call the 5-year property. You can basically write off within 5 years. The marginal tax rate is 34. Okay, assuming 34. Now let's see that the appreciation, the table provide is along that circle, this line. First year let you write 20%, second year 32%, 19.2, 11.5, 11.5. The conversion year, year 6, right? So what remaining 5.76. Now this is the table IRS provide for 5-year class asset. Now you write your depreciation. Depreciation, original price $12,000 times 20, you get a $24,000. $12,000 times 32%, you get a $38,400. Now this is the depreciation. Depreciation. So you use the original price time the table, the acceleration table, because just look at the second year, it gives you the highest write-off depreciation, right? 32%. You times that, get that amount. But on the book value on the, for example, year 6, at the end of a 5-year, is worth $691. So still have $691 on the book. Now let's look at if we sell this machine at year 5 for $3,000. Now this machine, for whatever the remaining value is, in the market, let's assuming it can be sold for 3 years, 5-year cars. So for $3,000. $3,000 is the selling price minus $3,000 minus the book value. Now on the book value, you still have $691.22. This is the book value. Now anything above that book value is capital gain. So you have to pay the marginal tax, 34%. So sales price minus capital gain tax equal to $2,215.01. Right. This is the after tax, the year end of the year after tax, salvage value it worth. Now you say if we sell it not instead of the end of the year of 5, let's say end of year 2, if we sell it, and in end of year 2, and end of year 2, there's a little bit newer car, you sold it for $4,000. So what is my after tax effect of that salvage value? So if the market value is 4,000, you minus whatever the tax effect here. Now, the market value at the end of year 2 is 4,000, but on book, you still have a book value of 5,760. So what do we have? We have capital loss. Capital loss. You have capital loss. Now, capital loss also will allow you to write off against your capital gain during the period. So you have a negative number, negative 5 times 0.3. You have the capital gain. This is a capital loss. Here's capital loss. Negative 598. You will be added to your selling price of 4,000 because you have a capital loss on your investment goods. The asset part here is negative. You ended with the net salvage cash flow of $4,598.40. The $598.40 is give you the credit. You receive the credit from the capital loss during you selling your car. So this is the salvage value at tax effect. Sometimes it can be very confusing. All right. Now, in textbook, they give you a pretty detailed, like a real-world example of capital budgeting. Give you a business case. It's by a company called Majestic Mulch Compost Company. It's a garden company, gardening materials. Please read the textbook chapter from page 286 to 90. They give you quite detailed the information, and then you do a capital budgeting on that. Now, in table 9.9, it basically gives you the given data. Here is a graph shot, a part of the spreadsheet. Now, first let's look at what we usually call in spreadsheet case. The first part is what we call the input part. In a spreadsheet capital budgeting model, first you need to give me the input. Those are the parameters you will use. Usually in the input section, all the number behind those cells are exactly exact numbers. By the way, I post this spreadsheet online. Let me jump to the online. I post this spreadsheet online. Let me see here. On week 6, reading and immediate, the red one, the Excel, the Majestic Mulch and Compose Company, Mmcc, this file. And this file look like this. Let me look at that. The spreadsheet. You have this spreadsheet. Download that spreadsheet, okay? And we're going to study and we're going to looking at how the spreadsheet is built, okay? Now, the analysis I'll provide here is we're looking at a section by section. Then finally, we're going to looking at the net present value, the internal rate of return, and also the payback period. How do we approach from input section? The input section, the first one. The input section, on each cell, if you click, for example, on E6, it'll give you them 3,000. Now, those are the sales number those given number. So all those things are given numbers. I want you to download this Excel and open this Excel, study the detail of each cell. The first section is the input section. The next section then will be calculate the depreciation, etc. And finally, you have the cash flow part. Now, in order to look at the formula behind the cash flow part, for example, if we want looking at the net income, the present value, you can highlight the cell of the net present value, then click Formula tab and go to Trace Precedent. It will automatically show you what the formula, or what the cell, relevant cells, which used in this formula. For example, they showed you here is the cost of a capital, here is the range, cash outflow, and cash inflow, etc. So using this trace to study each cell, particularly study the model part. Anything below the red part, red line, underneath is the model, is the spreadsheet model. Above that is input range, basically input. Models based on formulas. You have looking at each cell to find what behind those cells, okay? So let's go back. So this is the Excel sheet you need to study. Here, I'm just giving you some kind of a quick rundown of that particular spreadsheet. We are starting from the table 9.9. So it's input. For example, you are told the unit sales are given at 3,000 first year, 5,000 second year, up to going up, going down for 8 years. This is like a sales going up, going down. Then the end of 8 year, you liquidate the project line. The variable cost for that particular product is $60 per unit. Never change. I see. Fixed cost per year, 25,000. Sales price per unit is 120. And for 120 for 1, 2, 3, first 3 years, After that, it's 110. The sales going down. In order to, because the competition come in, you have to cut the price. Those are given data. Tax rate 34. Required rate of return on this project, the company, is 15%. And the net working capital for year 0 is $20,000 increase. For our original one, it required net working capital $2,000 or $20,000. But starting from year 1, the net working capital will be 15% of that year's sales. I think it's a reasonable assumption. It's more or less is inventories. So that one will be changing. The initial equipment to manufacture those mulch and compost costs you $800,000. The salvage value at the year 8, the salvage value we estimate is about like 20% of the value of the 80,000. By the way, in the input range, all those input can be changed. This is the beauty of using spreadsheet. For example, if the variable cost instead of 60,000, you can change it to 50,000 to see what happens, or increase to $80. Change 80. So change those things all changeable. The input changeable, but the rest of it should not. The rest of it is the modeling part. For example, in table 9.10, they showed you the depreciation. Now let's pay attention to particularly the salvage value part. We say that the machine at the end of year 8 has a book value of 0, but it will be sold at a market value, at the year end of the 8th year, will be 20%. Will be 20% of, 20% of 800,000 original cost. So which will be sold at $160,000. So the salvage value minus book value, the capital gain is the full amount, because on the book it has a 0 value. So every dollar subject to capital gain. The tax 34%, so times 34%, you get 54,400. So although you sold this machine for $160,000, the after-tax salvage value, after you pay tax, the net salvage value only $105,000 and $600. $600. So that is, in particular, the salvage value. It's kind of a little bit confusing part. It's partly due to the tax capital gain on that, right? Now this one is positive, so capital gain. There is no capital loss. Now let's look at the table 8.11. It's the net working capital change. Net working capital, by assumption, is the first year is 20,000, but then it becomes 15% of that year's sales. So the first net working capital 54 is we're using 15% times what the sales numbers are. Now, the sales number will be in the following charts. The sales number, see that? 360, which is the sales price times unit of sales projected, right? And in the spreadsheet, you can look in that. This one is a formula. Starting here is a formula. Now this portion is the pro forma income statement. Is pro forma income statement. You projected the cash flows. The bottom line are the net operating income, which is EBIT plus tax. I'm sorry, minus tax, not plus tax. EBIT minus tax. You get that number. Okay. It's not total cash flow yet. It's operating income. So you need to add the adjustment for the rest of it. So here, in this portion, you have the net operating income. The next portion, you need to add back depreciation to achieve the cash flow from operating, CFO, right? And adjust for net working capital, adjust for salvage value at the very end. See that? Salvage value 105,600. This is the after-tax salvage value. Then you have the total project line. Now this line, A20, 107, 169, that line is projected cash flow. We use that to calculate net present value, internal rate of return. Now, the calculation of payback period is a bit tricky, right? So let's move on. Now, I really need the table 9.14 is the calculation of net present value, internal rate of return, and payback period. Let me jump out to the spreadsheet itself. Jump this out. Let's look at how that be calculated. Now, I hope you will study this cash flow carefully, the spreadsheet carefully. That's the detail really is. So I usually, when looking at other people's model, I use the trace line to help me to do it. So you open that line, go to formula, and on the top, almost the end, there is a trace precedence, trace dependence, and a remove errors. The first, let's remove errors. Now I say that behind the, below the red line here is the model, is the spreadsheet model. On top are inputs. Inputs, particularly the blue part, you can change it. But the model part should not be changed. Okay? Now let's look at, for example, the first sales. Let's look at the first $800. $800. Looking at on top, how do I open this? This one. Okay, here is a little bit larger. Now, if I click the cell D35, which is the equipment cost, it shows me the formula equal to C14. Or I can click trace precedent. See that? Okay, that is equal to the input on C14. So if you assuming the equipment cost instead of 800, it's 900. You can change the input part, but all the rest of it still working. Okay, because in a modeling part, you are using relationship, not the numbers. You avoid using numbers because number is specific. As input, like a C14, is changeable, interchangeable. Now let's look at let me get rid of this first error, remove the error. Now I click cell E38. Then I click the precedent, okay? Wow, how do I get that number? I'm using E9 times E6, right? E9 is the number of units sold. E6 is the price. So you get that number. Now, earlier we said that net working capital, let me see, where's the net working capital here? Net working capital, let's look at, let's get rid of the error. Let's look at the sale of E45, the first net working capital, $34,000 net working capital on that particular day. I'm going to click the trace precedent. What he did is, first I need 50 net working capital. Sorry. First I need to calculate 54, which is the E31. E31 is a net working capital, which is the 15% times the sales number. You get 54, right? Net working capital. Now, if you're looking at the next year, the second year's net working capital, 90, how do we do that? Is 15% times F35. So those are the net working capital. But here, in the net working capital changes, the investment changes. Why is 34? Here is because originally the first year zero is $20,000. Now it's go to 54. So 54 minus this one is E31 minus D31. I'll do the calculation. Now, the most important numbers are all in row 47. Is the total projected cash flow. First one is 22,000, 820,000. Then the first year cash inflow 107, 169. You add those things up. So here along that line is the cash flow. The last one, year 8. It's quite complicated, the calculation, if you're looking at. You add all those three numbers, including cash flow, net working capital recovery, plus salvage value, which adjusts for tax, right? After tax, so 107. You add those three values together, you get 266. Now let's look at, so along the row 47, you have projected cash flows. This is what we need. Now we do the calculation, investment rule, net present value. Let's look at the row behind cell D53. D53 equal to MPV parenthesis C11. Now let's look at what C11 is. C11 is the required rate of return. Currently is 15%. Now if you change that number, then the present value will change, right? Comma, E47 to L47. Now it's from cash flow 1, 2, 3, 4, 5, 6, 7, 8. Then plus, because the initial cash outflow, $820,000 is negative number. They are using red net number, using plus. You add them together. So it is 65483. This is for net present value. This is the most important formula you have to know how to use it. Okay. The next we're looking at the internal rate of return. Get rid of this. Internal rate of return. Internal rate of return pretty straightforward. IRR equal to IRR parenthesis D47 up to L47. All those numbers. It gives you the number 17.24. This is internal rate of return. Now, the payback period is a little bit complicated. Payback period, the formula is a little bit complicated. Let's using the trace to see it. How do we do that? The payback period here is H33. H33, 4. Year 4 plus fractional. You are using year 4, but you're looking at a cumulative cash flow here. At the end of year 4, you still have $17,323 not recovered yet. Using that number divided by I-47. I-47 is the total cash flow for next period, year 5. So you have a fraction number of 0.08. Add them together, 4.08. So here, I think the payback period is a little bit complicated to calculate. Because you literally have to create a discounted cash flow and accumulated cash flow to find out those things. Particularly the cumulative cash flow in the 51 that sale, but particularly as kind of you have to do it, calculate to do it. Now, after that, this is your sale. This is the sale you make your judgment call. So your answer is that since net present value positive, we are saying yes to this project. Now, IRR rules is 17.24, which is higher than 15%, 15%. So it's yes. Now, payback period, we're never using this the criteria rule. So, but it gives you liquidity. It's about a little bit more than 4 years getting your money back. If the management says, okay, the payback period is 6. Now this one is okay. 5 is okay. If the payback period is less than 4, this one seems like violate the rule. But payback period, just a measurement of liquidity. We should not base it on that. So as a net present value say is yes, it's a yes. Now this is a very nice spreadsheet. On capital budgeting. I want you to study this. Now, for many people, if you have any chance in the future study MBA program, we're going to work a similar problem like that. Then we are looking at more detailed, looking at a scenario analysis, a risk analysis, etc. But here, let me just show you one thing. Why the spreadsheet is so powerful. So here, the project, we say the yes, based on discount rate 15%. The input is 15%. Now, in case not 15%, if the company cost is so high, let's put a 35%. 35% as their cost of capital. Their cost of capital is very high. Let me hit a return, 35. Wow, 35. The only thing I changed is the cost of a capital here from 15 to 35. The net working capital automatically changed for you, $3,000, 389, IRR 15. Right now, if I change to $35, let's just play around. I put a 50%. If the cost of capital is so expensive, 50%. Now you have a problems. See, the net present value is equal to negative 43. So you have to reject this project. I'm showing you is the spreadsheet, the nice thing about spreadsheet. You only have to change one input. A whole model change. The whole model change. This is the nice thing using spreadsheet to capital budgeting, which will allow you to make those changes. And later we will, and in the textbook, they're talking about those different scenarios, different salvage value, different variable costs, etc. What the impact on the net present value. Now those are all the management tools help you to understand the business. You'd rather make those scenarios, those different scenario, best case scenario, worst case scenario, on paper, not in reality. So you are working with the computer to see what happens. So what is the tolerate? What is the sensitivity of companies' profitability towards cost of a capital, for example? This one is a good example I'm going to show you. So please work on this spreadsheet. I'm not expecting you to recreate from zero. I'm not going to ask you to do that. But I want you to study it to see how the spreadsheet is built. Okay? And looking at how those numbers coming from by using, for example, the trace precedent or trace dependent, looking at particularly why those number, where the number coming from. The nice thing about spreadsheet is easy, but from programming point of view, you really don't know what the formula behind those numbers, right? You literally have to looking at the detail, the formula behind it. So you have to looking at highlight the cell and looking at how those cells is coming from, what the formula they are using. Okay, so for capital budgeting, I'm assigned certain homework, probably not so difficult as we discussed today, but you do need some spend some time to working on this case and familiar with yourself with a spreadsheet, the capital budgeting spreadsheet, and familiar with yourself what is the input section and what's the model section. And that is a very useful tool. If you have time, you spend it. You try to create this capital budgeting by yourself. But this is a good example. You're working with the existing project and looking at how that be done. All right. That's it for the capital budgeting. I hope you spend some time with this real model.